First things first, what's the general consensus when we look at the results released so far? Is the sector firmly in the green?
Well, I think, there is clearly a bifurcation in terms of the different performance between segments of the sector, where you have the high quality stocks that have very good market positions, strong pricing power, good distribution networks, having more or less overcome all those problems. The challenges really were more focused on the smaller guys who've had perhaps bigger problems accessing capital, for instance, or perhaps are not as powerful with the consumers, or not able to push their products through a much more robust distribution channel. So overall, what you find is that the high quality stocks have been able to maintain performance, have grown double digits in most cases, and are reflecting that in the prices as well.
When you talk about the high quality stocks, who are you referring to? The Nestle's, the flour mills, who specifically?
Yes, certainly. The guys with the dominant position. So the names are obvious: the Nigerian breweries, Guinness, Nigerian breweries, the Nestle's, flour mills. In their various sectors, there are different names in the various sectors. But there also, from the market perspective now, there's the aspect of name recognition as well, which has sort of helped push some of these prices as well. Beyond the performance, there's also the issue of how investors perceive the stocks. So if you're perceived to have a very strong market position and demonstrate that with strong earnings growth, then you see that being reflected in the prices.
Now, looking at the multinationals and the locals, it seems like the investors seem to be more interested in the multinationals. So how are local stocks faring then, if investors don't seem to want to put their money there?
Well, when you see like this break in market performance between two segments of the market, I guess the question is who's buying and why. What has happened over the past few months, or say over the past year, really has been the foreign interest in Nigerian markets. And it's not just Nigerian markets, it's a theme that's played out across all emerging markets, where the emerging market consumer is seen as a durable theme to go to push investors through this bump we're having in global markets. So if you're a portfolio manager sitting in, say, New York, Nigerian breweries, Nestle, perhaps 1% of your portfolio, but you want this story, right? And you're a bit less price sensitive. Now, nobody's going to question you for buying Nigerian breweries. Nobody's going to ask you, why did you have this in your portfolio? It's a well-known and well-accepted story. So therefore, that price sensitivity tends to reduce. On the other hand, the risk overlay is still there. People are still worried about the global economy, and they perhaps are not quite willing to go beyond that into what they perceive to be more risky. So to the extent that we don't have local investors playing too much in the market right now, that sentiment amongst foreign investors is what's really pushing that divergence in valuations between the multinationals, which are perceived to be high quality, like I said, and the domestic players.
But I think the concern for investors right now is the current environment. Rising raw materials, distribution costs, a high interest rate environment. With the CRR hike, we had the MPC meeting, and suddenly the CBN governor or the MPC didn't sort of reduce that CRR as expected.
I guess maybe that's a story for another time. I can talk about monetary policy in Nigeria all day, but I think they're well behind the curve. But what we really see is, yes, that quality story is there. There's a clear quality bias, but then you have to justify the valuations. At some point, the question becomes at what price, right? And when you see valuations in the mid-20s, then there has to be something behind it, and that's where the performance comes in. It so happens that those guys who are dominant, who are high quality, are also dominant in their markets. There's a reason why they are multinationals and they're so big in their markets. So for the larger part, they've been able to justify their prices. Once you see that performance coming through, then on a current basis, you're looking at valuations and you're saying, well, this is justifiable because that growth is there. On the other hand, some of them haven't done so well. For instance, you look at Guinness, which is high quality as well perceived, and it's also trading almost in the mid-20s. But over the past year, their capacity expansion hasn't matched the market. So Nigerian breweries is ahead of the curve. So where you have Guinness not really seeing that performance come through, their price hasn't moved in sync So you have Nigerian breweries on the other hand, which has grown 20% and is almost more than 30% up year to date. So, you know, you have to match those two values. The key investor value is quality, but then there has to be some justification for the valuations we're seeing now. On the other hand, local guys are still fairly valued. You know, I would say the valuations are in mid-teens or low teens even in some cases. And that's where really the opportunity probably is, when investors, the domestic investors now, who have a better approach, or who have a better view of these stocks, are perhaps going to come in and make up for that gap at some point. You always see that convergence at the end of the day. It's always an issue of mean reversion at the end of the day. So that's perhaps where the opportunity, if you're looking forward, you know, you don't make money by being in the current story. You need to look, see what's next. That's the key driver.
I mean, you did mention Guinness, and I'd love to talk about that stock. We had the CEO in yesterday. He mentioned expansion plans of 52 billion naira. He also mentioned a new launch. I mean, isn't that good for the outlook of that stock?
Oh, absolutely it is. I mean, there is a powerful story behind the consumer in Nigeria. The demographics, as we always say, very favorable. The economic cycle, in terms of a secular theme going long into the future. So there's a lot of growth, there's a lot of opportunity, there's a lot of space for companies to innovate and address a market that exists but perhaps is untapped to a large extent. So there's always that opportunity there for those willing to invest. And that's also one of the reasons why the dominant guys are doing so well, because they have the capacity to do that. They're able to access capital, which isn't so much the case for the smaller players. Now, Guinness has been a little bit behind the curve in the sense that where Nigerian breweries started their expansion program a bit earlier and chose an inorganic approach, and bought up guys and were able to ramp up capacity quickly. Guinness perhaps they didn't have the kind of support from their parent company that Nigerian breweries. You heard him say, they're resorting to finance leases, and that's having an impact on earnings because of the interest charges. In Nigerian breweries' case, it was a bit more. The approach was a bit more favorable.
That's right.
So clearly, that's filtering into Nigerian breweries' performance faster than Guinness. But going forward, you have to always look forward. Going forward, Guinness seems to be the one with more headroom because you're coming from a slower base. According to what he says, their capacity expansion plans are much larger, and therefore that fit-through will probably come in forward. But again, it's always a question of price.